Britain's banks will be told this morning how much more capital they need to raise to ensure they can absorb potential future losses. Some people in the industry have suggested the requirements to hold so much capital has deterred banks from lending. Here's our business editor, Robert Peston.
More than 4 years on from the great crash of 2008, Britain's banks still don't have enough capital to absorb potential future losses on loans. That's what the Bank of England's Financial Policy Committee will rule today in its first big initiative since it was created by the Chancellor to maintain the stability of the banking system. It'll come as something of a disappointment to the banks, which have been taking steps to strengthen themselves. But the view of the Bank of England is that banks won't provide the credit badly needed for economic recovery unless and until they raise additional capital.
Robert Pest, on the line now, economist and wealth manager Jonathan Davis. Jonathan, good morning to you.
Hello, Ronnie.
We're back down this road now. The governor, the headmaster, gets the banks in front of them and says, right, you're not holding enough capital. Have they learned anything in the last 4 years at all?
Nothing, nothing whatsoever. The banks, for every £97 that they lend out, they've got £3 of capital. Now you think about that. All they have to have is a few businesses go bust, and let's face it, we've not got any economic growth, so it's highly likely, and it's been happening, and their capital's wiped out. The bank is bankrupt. Of course they have to raise more capital, because inevitably it's all going to happen over again.
Where will they raise the capital from?
Well, they could start by reducing the vast bonuses they're paying to their executives. I think the Lloyd's Group, which is over 40% owned by you and me, I think it paid many dozens of its staff over £1 million last year. RBS, which is 82% owned by you and me, made a loss of £5 billion and paid out £600 million of bonuses. So one thing they can do is reduce bonuses. Secondly, they can sell off parts of the business and raise some cash that way. And thirdly, they could reduce the dividends that they pay out to shareholders. And finally, fourthly, they can actually raise money by selling shares in the open market.
You see, the thing that we were always warned, after the big crash, is that we, as individual people, we have to look at our costs and get our credit card bills down. And I think, I don't know whether that's true or not, whether we have done that, but I think there's an effort for people to reduce their credit, yet the banks are still going on. And we've seen in Cyprus where people who've got savings are going to be taxed, as it were, effectively. That couldn't happen here, could it?
It certainly could happen here. It can happen anywhere in the world that a government decides to make a new tax. As you say, the Cypriot depositors are being taxed. It's not directly because the banks have gone bankrupt, because actually those banks are in some ways as bankrupt as our banks are, but our banks are being kept afloat by you and me, the taxpayer, via the government. The Cypriot depositors got a new tax. Yes, it could happen here. Is it likely? No, it's not. But then again, was it likely that the government would step in and bail out the banking system as it does? No, it wasn't. So anything could happen, and you and I are paying for it.
Jonathan, good to talk to you again. Jonathan Davis, who's a wealth economist and wealth manager. I happened to say this morning to the guys that I really am good now about moving bank. I don't have many bank accounts, but I moved my bank account now. It's really competitive. I'm doing things like whenever I get a quote on insurance, I instantly look for a reduction. Are you the same as well? When we hear that the banks, the institutions that are actually supposed to be looking after money, they are not holding enough. What about you? Are you saving more? Are you moving your bank accounts round? You can call us 0845 925 2000.